Michael, this one stock you like at the American Century Value Fund is Devon Energy. Now, it's come back better than a lot of the other shale players, but there's still a lot of worry about the sector. Why do you like it?
Sure, Greg. American Century Value, we do like Devon Energy, and we like it because they have good positions in their acreage in the United States. They've really changed their portfolio, they've revamped it, got out of their international positions, and they have strong positions in the Permian Basin, the MidContinent Basin, and in the Eagle Ford Shale. And in addition to that, they have a hidden asset, an oil pipeline in Canada. They're going to take that and drop it down into an MLP. When they do that, they'll take that cash from that transaction, reinvest it into their acreage, and be able to produce more oil and more gas. You combine that with a really good balance sheet, and we think we've got a pretty good risk reward on a company that's under earning right now because the price of energy, both oil and gas, has come down so much.
Well, let's stick with oil. You're also a fan of Total. Pays a nice 5.2% dividend. Is that why you like it better than all the other oil majors out there?
Greg, it's a little bit more than that, but that's a good start right there because they do have an outstanding dividend. What we like about Total, first, they have a great balance sheet. It's one of the first things we look for at American Century Value Fund. But also, they were one of the first, we believe the first, integrated oil company to recognize that costs need to be lower. Price of oil kept going up, but price of costs to produce that oil were going up even faster. And so 2 years ago, they started about cutting back on CapEx, reducing their costs, putting pressure on their suppliers because their returns on capital were under pressure. And so we think they've got a lead on some of their competitors. In addition, Greg, they also have really moved their portfolio. We were talking about how Devon revamped their portfolio. Well, Total has done the same thing too, and they used to be very heavily dependent on short-lived assets. They've really moved the needle and made the mix of long-lived assets much larger part of the portfolio. About 5 years ago, about 25–30%. Now it's more like 45–50%. So that's why we like Total.
And you're also positive on Pfizer. Stock's up around 10% year to date. A lot of people love healthcare, but it's been fairly quiet when it comes to M&A on the Pfizer front. And I guess they also have a lot riding on their Ibrance, which is their breast cancer drug. Can you tell me your view of Pfizer?
Greg, we still like Pfizer, and we like Pfizer for several reasons. One is the balance sheet optionality. You talked about M&A. They're going to close on their acquisition of Hospira, which is going to bolster their their established product business. And also, we think they're going to do another branded acquisition, and we think they'll use that balance sheet, that flexibility that they have, to really add value by going after another branded player. AstraZeneca, they wanted to go after that. It didn't work. The board of directors at Astra was not interested. That doesn't mean that they're done yet. And in addition to that, they've got a pipeline that we think does not get as much credit as it should. You talked about Ibrance, and we think that's going to be a big winner for them. But they also have an entrant into the immuno-oncology race. That's the biggest area under development in oncology right now, and it should be because it's very exciting things that are going on there. But they have a collaboration with Merck KGaA, not to be confused with Merck in the United States, and so we think that has moved them up in the race against Bristol Myers and Roche and Merck in the United States in that immuno-oncology space. In addition, they are also developing a cholesterol drug, a PCSK9 drug, to fight cholesterol, lower cholesterol. Think of it as a statin on steroids. These are for people who do not get to a cholesterol level they need to be or their doctor wants them to be. So they're not getting there on statins. This drug is going to help people get to where they need to be.
All right, and then finally, you are constructive on GE. And GE is deconstructing itself. It's going through a lot of changes. Why not wait till it's done with the overhaul as opposed to getting in now?
Greg, we think if you wait until they're done with the overhaul, it's going to be too late. They are a long way towards getting where they need to be. Before the recession, their split of profits between financials and industrials was 50-50. When they're done revamping the portfolio, it should be 90% of profits from industrials, 10% from financials. And so we think that they're going to be able to return $90 billion to investors between now and 2018. They're going to lose the designation, hopefully, as a systemically important financial institution as they reduce the balance sheet, as they reduce their exposure to financial assets. And you combine that with some pretty good businesses where they have leading market share positions. It's a great model, Greg, where they have these leading market share positions, but a tremendous amount of reoccurring revenue from the services that support these leading businesses like locomotives and aircraft engines and gas turbines and medical equipment. And you top that off with the Alstom acquisition, which they're waiting to get European regulatory approval for. We think that could add 15 to 20 cents to earnings. That's a pretty good deal for investors.
All right, thanks a lot, Michael.
Great. Thank you.
And thank you for watching The Street.